Good morning. As the panelists are getting seated, I am John Imhof. I'm a shareholder in the law firm of VedderPrice, with offices in Singapore, London, and across the US. I do maritime finance. The banking ship finance has been a very challenging time for ship finance since the financial crisis 10 years ago. There have been new entrants, including Chinese leasing companies, who've come in to pick up some of the bank lending that's faded away. Also, private equity-backed leasing companies and private equity have come in, and a lot of lenders spent the first 3 or 4 years of after the financial crisis kicking the can down the road and amending and extending. We've seen some banks withdraw. We've seen some private equity investors now limiting their investment after fatigue and getting their fingers burned, or the usual descriptions. And the Chinese leasing companies and other leasing companies rushing in to fill the void. Some of the banks have been selling their shipping and offshore loan portfolios. But more recently, banks have been coming back into the sector, clearly returning, new banks entering for the first time. At the same time, the shipping industry, as we've seen, is facing new and enormous challenges that it did not exist 5 years ago. So with the banks and leasing companies still representing the bulk of the financing available for shipping and offshore, we have here some of the most distinguished panelists from some of those very important shipping lenders and leasing companies. To my left is Zhendong from Bank of Communications Financial Leasing, Deputy Head of Shipping Finance. To his left is Shreyas Chipalkatty, who is Managing Director, Global Shipping Logistics and Offshore at Citigroup. To his left is Ivar Hansen, who's Managing Director and Head of Private Placements and Loan Syndication at DMB Markets. To his left is Martijn van Tiel of DVB Bank, Managing Director, Shipping Finance, Western Hemisphere. And to his left is Bill Gao, Executive Director, ICBC Financial Leasing. So first, I thought we would begin by kind of surveying the field and what you've seen happening. How would you all describe the state of the shipping finance market these days? Maybe I can begin with you, Zhendong. What do you think?
For the current shipping finance market, and in my view, it is still on the way to recover. And after financial crisis and latest financial crisis, and European traditional lender had scaled back and even quit a little bit market. And the Chinese leasing company has just largely filled that gap up. And so far, according to all our calculations, and in 2018, and the Chinese lenders, including leasing house, has already accounted for about the 20% of the total drawdown for shipping finance. So that is the current stage. Okay.
Bill, you had last year you said it was around 15%. Do you agree with Zhendong? Is it up?
Thanks, John, and push the question to me. Yeah, I still recall the last year, and thanks for thanks for the invitation by Capital Link. It's my great honor to come back again. Yeah, I recall the last year I said about 15% of market share and taken by the China leasing house, and in 2017. So, and also based on my friend and Zhendong and the new figure, which I also agree on. So actually the figure being increased. So, and from the China leasing house also, plus some of the, say, the policy banks by Chinese and government support. So the ratio has been increased to 20%, which hadn't been included some ships built by the leasing house directly by themselves. So the figure may be a little higher even. So agree on the figure shared by the Zhendong.
And Martijn, from the position of a lender, and a long-term lender into the shipping community. What is your view of the markets these days?
I think the ship finance markets are reasonably healthy, thanks to performance of our clients. Shipping markets are doing reasonably well, and that's where it all starts. There's plenty financing available, not from so much from the traditional sources, which were the cheaper ones. So. Financing comes in many shapes and forms these days and at different prices. But I don't see any ships that are not being financed. They're just being financed at higher cost.
Gotcha.
Yeah.
Tuijl, you are. Can you add and maybe tell us a little bit about what you think the banks have learned from the experience over the last 10 years?
Thanks for that little extra twist. Martijn, I think, made a good assessment of the fairness of the finance market. I can't say that I disagree with that, considering the market has performed, again, reasonably well. But to your point, John, I think the challenge that banks are facing these days is much more of a sort of market fatigue than anything else. I have the luxury of following both the offshore and the shipping maritime market, and there's always been a fair amount of overlap in that space. When the shipping markets went to a deep dive at the end of the 2008, 9, 10 period following the financial crisis, a lot of those banks went into offshore. And then with the sort of late 14 collapse of the offshore market, there was nowhere to go really. It was the markets were just down all around, and we're now in the, I want to say 4 plus, maybe 5-ish years into that dynamic where no market has been a safe market. Again, yeah, there's healthy banks following a lot of recapitalization. A lot of the solid companies, whether they're private or public, are still, performing, again, reasonably well. But I think we're starting to sort of come up to the end of the line, and it's really going to come down to who are the best defensive, bank out there. If there's any lessons to be learned, there's really to have an excellent dialogue with your clients, early dialogue if things are not shaking out the way that they should. More expensive financing is not necessarily always the answer. I would hope and trust that people realize the value of putting in equity and raising equity if and when they can. Yeah, it's a reasonably well-functioning financing market, but we're in desperate need of a more sort of solid recovery in markets on a broad scale, I would say.
And Shreyas, do you agree, or are there bigger factors at work? Basel IV regulation coming down in 2 years, going to make lending difficult, more expensive? What other factors are there besides fatigue?
Yeah, thanks, John. First of all, I want to say, Tuijl, I think you were being cynical when you said the luxury of covering the offshore market. I mean, my God, it's the first time I've heard that. But yes, capital costs are going to go up because of Basel IV. And that essentially means that the little nascent recovery we've seen in terms of European banks coming in cautiously back into the shipping lending market over the last sort of 18 months, I think that might be put back into question. We need them. We need them to come in because the transactions that are going to happen, there is still some consolidation left to do in the tanker market and in the container shipping market. Dry bulk, Citigroup doesn't really play much of a role on the lending side, but for those two markets, certainly there is some consolidation. And we will need capital to come in and help with that. So that does not bode well in terms of higher capital costs. Margins generally still remain compressed. I think people are overall still reluctant to price capital at the levels at which it should be priced. It's not in any way a reflection of the competence of my banking colleagues, but it's just the way that, as Ivar put it, listening to clients and making sure that cash flows and collateral actually make sense to lend against. So for us, I think the headline really is things are looking better, but with higher capital costs in the offing, it could be a little bit more challenging in about a couple of years' time.
And how has your approach to lending changed over the last 4 or 5 years as you've seen the market develop as it has? Do you have any thoughts on that, Shreyas?
Our approach has, I mean, for Citigroup, and it's been pretty standard, which is that we look at the shipping industry as part of the global logistics space. It is really the business of moving things from A to B, making sure that when we have clients who are borrowing from us, these are large, global, sophisticated clients who are able to use the Citigroup machinery in 100+ countries. That's how we make money. So just lending for yield is not our business. We definitely like larger clients, and we've stuck with that particular strategy over the years. That has not changed.
Okay, Martijn, does DVB follow the same kind of approach, or is yours different?
I think the question is how has it changed our behavior in the lending space? It's a little bit once bitten, twice shy. We were, by our DNA, we're more of an asset financier with trusted clients than we are a balance sheet bank. We haven't changed, but we're a little bit more careful. That being said, we still do plenty of business because that middle space of owners is wide and deep. And we're very happy doing deal making in there, but we need the markets to stay where they are and not get worse, and then we in our happy space.
And for the finance lessors, this has been a tremendous opportunity. Obviously, you've had quite a run. Are you experiencing any of the same concerns that the lenders are expressing, the banks are expressing, and how has that changed what you do? As a finance lessor?
Yeah, I do. And compare maybe in the 4 or 5 years ago, I think because China leasing suddenly raised up, I think I would say, especially for those and I would say the asset base, the heavy asset, for example, like ships, might be easier to get the higher leverage from China leasing house. So I think maybe this kind of the motivation for lots of international ship owners try to go to China, Beijing or Shanghai to looking for the alternative, I would say, the financing resources in China by using the leasing house. And of course, for, I would say, the working capital, some of the short term and the funding, they still go to the traditional, I would say, the shipping banks, to sort out the problem. But I would say for this asset base, the shipping asset, they could try to do this. And back to 4 years ago, when the China leasing in general tried to go to the China international market, we did offer very high leverage, some even close to 100%. If some ship owner have the chance to talk with us, I think right now we are try to learn from the European and the banks and try to control our risk also to lower our leverage. So now it's much more, I would say, leave the higher. We try to benchmark with the European or I would say the Western banks. Not too high, but not still keep our competitive for the shipping finance.
Yeah, I think the last financial lease I saw come out of a Chinese leasing house, which not represented on the panel, was around 85%. And with an implicit rate when I plugged it into a reverse calculator of around 5 and 7, 8%. Are those days gone, or will they ever come back?
I can't just give you the direct answer right now because it's very commercial and sensitive. But I would say, and as I said, we are very benchmarked with the Western banks. If the Western bank provide 80%, we have to provide 85%, right? Okay. So, and this kind of the game we always play around. So it's very hard to give you but also it's based on the asset, the segmentation, dry bulk, LNG, tanker. They all get a different, I would say, the percentage of the funding.
And Zhendong, is that the sort of the experience of BOCOM Financial Leasing, or you have a different perspective?
And if the risk is well controlled, so the high leverage solution to the shipping market is still widely available, provided by Chinese leasing house, I believe. And So regarding to the pricing, and I'm thinking that the strategy that Chinese leasing industry taken is going for first layer clients, and that is the request by the market. So I do believe, and we will still be very competitive, because according to my observations and from the deal that made by the Chinese leasing firm in 2018, the pricing range is around 5 to 6%. And if the sector is providing a stable cash flow in, I mean the forecast. So I'm still thinking, and the funds coming from China, particularly from the leasing house, is limited to the first tier market only. That is why, and the high leverage, and with a little premium on pricing.
And when you say first tier, what, without naming names, I mean, what kind of what do you look for in a charterer?
Sector leaders of different markets will be our target market. For instance, and that we have providing our facilities to top 5 liner companies, and also some very much important participants in supplying oil or gas and to the market. That is all our target market. I think also, and we were looking at some opportunities coming from the trades from US to China. There will be huge and transportation if the trade dispute will be settled soon. So we guess, and if the COA be materialized, or if the cash flow, and what I want to say is cash flow is clear, be secured, then, and we are thinking this part of business will be first tier business and first tier client base.
Got it. Good. And going back to the lenders, tell me, Shreyas, what is Citibank's target client? What is an ideal client for Citibank? Is it a big multinational public company that can tick all the right boxes at Citigroup, or tell us a little about what you look for in your borrowers and your customers.
Sure. Yeah, for us, a larger global client, whether it's public or private, doesn't matter, but a large global client is the ideal client. And the reason is simple. I mean, we would like them to use cash management, derivatives, FX, capital markets when the time comes. All of those products, we would like them to use those. So that is the driving element. But also, I think there is, based on what Zhendong just said, there is a drive that these top-tier clients are all getting a lot of attention from the same banks in the industry, so that it's driving pricing down. And so then that puts, again, in a vicious cycle, it puts pressure on returns that the banks can make. And then the banks then all of them start cannibalizing the same wallet in terms of what that company can do. So this obviously creates opportunities for the alternative lenders out there and the deep middle market that Martijn referred to earlier. That's great for them, but I think from a Citi perspective and for larger banks, and to some extent what Zhendong is saying, it's a challenge. And also the other thing to remember is that within larger banks, the shipping, logistics, offshore, cruise sector, these are all, even in aggregate, very small part of the overall bank's balance sheet. So these sectors are competing for attention internally in large banks for that capital. So unless they demonstrate returns, they will not get approved.
And for Ivar, do you agree with, is the DMB Markets Approach similar, or is it different?
Yeah, no, I think Shreyas put it very well, and although DNB is not as big of an institution as Citibank, again, it's nothing against private owners at all. I mean, we have some really good private companies in our portfolio, and I think private owners with their history and their commitment to the industry is, I think, why this industry is as great as it is. But as a bank, the unfortunate reality is that we are very much dependent on being able to generate sufficient returns from a relationship, and that again, lends itself much more, pun intended, to a public company with access to public debt, public equity, and more sort of a broader spectrum of products. That's the reality. And you asked earlier how banks maybe have changed over the past 10 years, and I would say that's probably the one thing that DNB has invested most of its time and focus on, is really to become a better bank for its clients with a broader spectrum of products.
And Martijn, the DVB's got a slightly different approach, I would think.
That is, obviously that's a function of the space to the right of me being crowded, competitive, and with guys that are have the ability to price lower than we can with our capital and funding base. So our natural place on the spectrum is towards the higher margins. I always joke we're the last stop before the desert starts with all the alternative lenders. And we try to find owners, a little bit of a cheesy answer, but that we can add value to. There's a lot of owners that have been banking with us for many years, grow big, and then grow bigger than what we can offer them. And we always look for the next company that is ambitious, can grow. It's a little bit more tailor-made, a little bit more daring maybe, but that's how we need to earn and prove we can earn better margin.
Good, good. And to turn the question I asked Zhendong around, we asked you what you look for in a charterer. I'll ask Bill, what do charterers see in financial leasing that they don't see in pure debt or lending from banks? What is it that draws them to financial leasing? Is it the high advance rates, or is it something else?
We have to sometimes face the charter party. So one side maybe the purely, I would say, the technology provider, the traditional shipping company, and on the other hand, there's some of the chartering part actually is the cargo owner, the oil company, maybe the miner company. They used to work with the traditional European and American shipping company. Now they approach the leasing house. Why not just play like the traditional shipping company and buy the ship and charter to us? So from that perspective, back to John's question, right now we have to do the internal evaluation. So who is our real customers? Should we continue like the financer to working with the traditional shipping company, or we maybe also involving some of the, I would say, the cargo owners' requirement, try to become like the shipping company serving some of the, say, their requirement as well. So I think right now we still want to play maybe the safe way. So we are maybe try a little bit of percentage to provide, we call this operation leasing, which means we buy some new ships and offer to some mining company and oil company to do the operation leasing to give them our ships. But on the other hand, we still play like the traditional financer again, but leave the higher leverage and with the competitive rate to finance those and the traditional shipping company. So that's we are doing with different requirement for the charter party.
Got it. And Zhendong, do you have anything to add?
I agree with Bill. The only thing we are looking at is where's the transportation, where's the real demands for the transportation. And when we realize that the charterer, and if they do the transportation by themselves and they have the cargo to be transported, then we are going to support the reasonable project if we are able to provide the right tonnage to them. So I'm thinking the market is changing. So the charterer and also the cargo owner, they have become a force and to borrow the money from the leasing house. So I think we need to stick to the real transportation.
Let's look forward now a little bit and see where we're going in shipping finance and offshore finance. Shreyas, where do you think the challenges are ahead for finance in the shipping and offshore sector?
So the core challenge is going to be returns and growth. and that's at the top level of any bank, but for our industry and for lending in shipping finance, that's the core challenge. So the way to address that, and I think the steps are already beginning to be seen, the way to address that is which bank can actually be a partner to our clients in creating the ecosystems that we've been hearing about all morning. The ecosystems begin with partnerships, and there are already a number of partnerships that are taking place, whether it's Maersk and IBM, or whether it's Nakilat and Maran, or you can find any number of JVs and alliances within the container shipping business that speak to that. But who is the bank that can bring in, connect the gas molecule to the LNG ship, to the power plant, to the electricity storage grid, to the electric vehicle fleet, and then how do you use the data that arises from that to make sense out of all of these flows, and then monetize that? And how can you, as a bank, create trade finance securitization products around that? That is the challenge of the future, and the banks that can do that are going to win.
Ivar, do you agree?
Wow, that's the one. Shreyas, I think you've taken this further than I had certainly expected it this morning. But the reality is that even at DNB, again, being a smaller bank than Citi, we have constant dialogue internally about the access to the data that we're sitting on, and how do we become a better bank for our clients with that intel, if you will. And I think, again, Shreyas put it very well. There's a host of information out there, and it's a matter of connecting the dots and being a better provider of, call it solutions, call it products, call it interface. Again, at DNB, there's a lot of focus on this, the fintech industry building up. People that has some genius idea for a very user-friendly app. In Europe, at least now, they can source banking products from any bank through an open platform, and basically compete with the established brick-and-mortar banks for their savings products and deposit products through phone apps. And so what is going to be the distinguishing factor for the banks is, again, what Shreyas put. I mean, how do we add value to clients with different needs and different challenges going forward, whether it's regulatory, environmental, or what have you. I totally agree with Shreyas, and the future is here, and it's really about how we adapt and make it again, and also, to use a word from Martijn, be value add to our clients.
Yep, Martijn? How about DVB? What are the opportunities and challenges ahead for DVB?
Listen, it goes for everybody on this. There's a battle for the balance sheet. Whether you're a bigger bank and you're in a shipping unit, you have to compete for your space on that balance sheet, and you have to show returns. That's a battle we fight constantly for our clients, providing access for them to a balance sheet. DVB is the same. We're a shipping bank, sure, but we're part of DZ's balance sheet, and they have their own considerations, saying, listen, are you returning enough for us for that to be interesting? The biggest threat to the ship owner industry is that our share of traditional balance sheets are getting less and less. So it is finding the new balance sheets, it's finding other balance sheets, be an intermediator for finding a new balance sheet. That is, I think, the challenge. And yes, you got fintech banks now that come up with the money, and soon we'll all be working for Amazon, because that is going to be the biggest bank. So find me the new balance sheet that is willing to take on this risk and price it accordingly.
So would you team up with alternative finance providers? Do you team up with them?
Fantastic. They give 75% to my client, and I do 45% senior in the back. Great new customers. I mean, very good customers. Thank you.
Are we looking at Chinese leasing houses as alternative financing? I think the fact that they are now on the same panel means they are mainstream.
No, I think they are now part of the established finance. With that question, let me ask Zhendong, where do you see financial leasing going We've heard about double-digit growth year over year, large amounts of loans going. Will that continue? Can it possibly continue?
So growth rate in 2018 is about 5%. So it's slowing down. And after a 3-year average drawdown amount of Chinese leasing houses, about $12 billion a year. And I guess this year, the industry will keep the same growth rate. And if it happens, there will be about $13 billion going to be supplied to the shipping market. And I think the structure of this drawdown might be a little bit different. And in 2018, and 29% of the money is going to bulker sector, and 21% goes to tanker, and 18% go to container. Another 21% is going to gas sector. And I believe in 2019 there will be less money going to dry bulker because the industry has a little bit cautious about the dry bulker sector. So there will be slowing down, but the size of the money that's provided by Chinese leasing houses already not small, and which is account for 20% already. So if the industry can keep this pace, and 20% and is already very difficult to keep, and I believe 20% and so far will be still figures that the industry needs to consider. That is.
We have a couple minutes for questions from the audience. Any questions?
Maybe just one comment from my side. So, I just try to say that the people feel like we're growing very fast, but actually, we already try to slow down. But the whole shipping portfolio, for example, like ICBC Leasing, shipping portfolio take even less than 1% of a whole ICBC bank portfolio, which means even every year we put in the $3 billion into the shipping finance. It's still very small portion compared with the whole ICBC bank. So the pressure still on us. We have to put $3 billion into this shipping finance because there's the bigger and the mother. I would say the big portfolio and waiting for us to do the comparison. So keep us growing. So I think just get to that comment.
Well, thank you, panelists. Thank you very much, and thank you, Capital Link. It's been a pleasure, and hope to see you next year. Thank you. Yep.